Well, hi, everybody. I'm Rick Edelman. Thanks for joining us today for this, what is turning out to be an urgent and timely conversation about crypto. Officially, we're going to be talking today about Solana staking ETPs and talking specifically about Bitcoin's BSOL, which is a brand new ETF that is really fascinating, and you're going to want to hear about it. But we need to talk first about what's going on in the world of crypto with the pricing and market activity. Nobody better to engage in that with us than Matt Hougan. He is the Chief Investment Officer of Bitwise. Matt, great to have you back with us. Thanks for joining.
Thank you for having me, Rick. It's good to see you.
Matt, of course, is one of the leading experts on crypto. He hailed from the world of TradFi, as I do. Matt was the CEO of ETF.com back when nobody knew what an ETF was or didn't believe they would have any staying power. He wrote the CFA Institute's Crypto Guide, and he is a columnist for Forbes on crypto as well. His weekly missives are must reads if you want to know what's going on in the world of crypto and staying up in the latest. Matt, you're a household name in the world of personal finance and investment management, but talk about Bitwise Asset Management, who you joined way back in the beginning. Not everybody understands or knows just how old and big Bitwise is.
Oh, thank you for that lead up. Yeah, Bitwise is a specialist crypto asset manager. We were founded in 2017, so we're been through about 8 years of crypto, multiple bull and bear markets. Today, we manage around $15 billion in assets globally across US ETFs, European ETFs, staked assets, and some active strategies. We're a team of about 130 people and growing, and we exist exclusively to serve the financial advisor, family office, and institutional market. Those are the products we build, including you see us ringing the bell for our spot Bitcoin ETF, BITB. We'll talk about our spot Solana ETF with staking, BSOL, but also the education we do, working with folks like DACFP, writing papers for the CFA Research Institute. We want to be the army behind advisors as they enter and help clients understand and, for the right ones, allocate to the crypto market.
So we are going to be talking about the newest ETF you've launched that is very innovative, very important, very timely. But the most timely of all is what's happening in the marketplace. And by the way, you're welcome to ask your questions. Many of you did. You sent us questions when you registered. I'll be hitting Matt with those as we go. You can also type in your current questions. Go to the Q&A box at the bottom of your Zoom screen, and I'll be checking those out as we continue this conversation. Crypto is down 25% or so from its all-time high. Bitcoin is now down for the year. What's going on, Matt? Why is the price dropping, and what do you see coming up next?
Yeah, like anything, there are multiple factors. I think the biggest one is that people are worried about the 4 year cycle repeating. And OGs, whales who have been in this space for many years, who may have bought Bitcoin at $1 or $10 or $100 or even $1,000 and are sitting on 100x gains, don't want to live through the next bear market with 100% position in Bitcoin. So they've been selling their Bitcoin. We still have institutions buying Bitcoin. We still have corporations buying Bitcoin. We saw El Salvador buying more Bitcoin. So these institutional forces are still accumulating. But because you have this fear of the 4 year cycle repeating, some of the OG whales are taking some gains in the market, and that is suppressing price. There are other factors going on. I'm not the first to tell you that the broader stock market is worried about the AI bubble potentially, about issues in private credit, about stress amongst lower end consumers. There are reasons to be worried more broadly about assets. But I think the big one that's crypto specific is this sort of self-fulfilling prophecy of worrying about the 4 year cycle repeating, selling ahead of it. My view is that we're near the bottom of that selling. I'm actually pretty optimistic on these prices. That doesn't mean it can't go a little bit lower, Rick, but I think 2026 is going to be a great year. And I think people will look back on these prices as an interesting entry point.
I agree with you. And what I note are a couple of data points in support of what you just said that institutions are still buying. Is Harvard and their endowment fund. Their CIO very famously said some years ago that they expected Bitcoin to hit $100 before it hit $100,000. And then they made their first buy of Bitcoin this year at 116,000. And they recently bought more. And Bitcoin, according to their latest SEC filing, Bitcoin is now their biggest liquid asset in the Harvard Endowment Fund, which it's nearly $500 billion. And that to me is astonishing.
That is astonishing. It's worth noting we should congratulate them on their converting and realizing that they were initially wrong. They're not alone in that, right? You can find a Michael Saylor tweet from 2013 talking about how Bitcoin was worthless and tulip bubbles and going to zero. And now he's one of the largest holders in the world. We all learn this space over time. I think Harvard is probably the tip of the sphere. I wouldn't be surprised at the end of next year if half of the Ivies had Bitcoin in their endowment. People may wonder why this is happening now. And my answer to that is I think most of these institutions started looking at Bitcoin in earnest when the ETF launched. Before the ETF launched, it was in a regulatory never land. It was hard to hold in custody. It was too difficult. You could just dismiss it. They started looking at it when the ETF launched. They probably talk about it every quarter. We know at Bitwise that our average advisor does 8 meetings with us before they allocate. Well, if you start counting quarters from January 2024, you get to 8 right about now. And so I actually think there is this second wave of institutional adoption that has been studying this asset, coming to understand the debasement trade, coming to understand digital scarcity, and starting to allocate. So I don't think Harvard's going to be alone. I think we're going to see a lot of endowments and bigger institutions, insurance funds come into the market next year. And I think it's going to make a big difference in price. It's one of the reasons I'm confident that we're going to rebound from here.
2 points to that. One, as you noted, Harvard changed their opinion, went from haters to lovers. I have seen, you have seen lots of haters to lovers, but I don't think we've ever seen a lover to a hater.
It's so true. It's a one-way street. Yeah, find me one on Twitter. It's really hard. It's really hard to find, and that's because once you see it, you can't unsee it. Once you understand the service that Bitcoin provides, once you understand the worries about the fiat system, once you understand that we're just living in an increasingly digital age, and you align behind those three themes, it's hard not to imagine Bitcoin being worth significantly more than it is today. I think that's why it's a one-way street.
I would also note, as you did, that there's a lot of institutional buying. And I think this is why Bitcoin's price has, I'll put it in quotes, only dropped to around 90,000 as opposed to falling to 60,000, a 50% drop or an 80% drop. If this had occurred 5 years ago, 10 years ago, I think we would have seen a 70 or 80% drop. It's only been 25% because although there's been a lot of whales selling, there's been a lot of institutions buying, providing that floor, which is why I think the volatility is being reduced. We're not going to see an 80% decline. Those days are over because too many people with too much money are recognizing these as buying opportunities when they occur.
That's exactly right. And I think a really good point. They also have different time frames. They're not short-term oriented, they're long-term oriented. They rebalance, so they buy when the price is down, sell when the price is up. They're a different type of investors that not only provides this floor, but as you said, drives the volatility of the asset down. And I do think we would be significantly lower without them. If you look at the level of sentiment in the market, we're in the extreme fear category of crypto sentiment, right? That's usually correlated with those 80% drawdowns that you're talking about. And yet, if you look over the course of a year, we're down what, a couple percent, right? Yes, we're off the highs, but it's not actually that horrible. I think it's exactly what you're saying. We have this new class of investors. They move on a multi-year time frame, they move in size, and that's providing that cushion and eventually will provide the spring that takes us higher.
One last comment on this comes from Matthew Ferguson, who just typed in about asking about Japan's yields causing some selling. What do you see on a global basis regarding crypto prices?
Well, I think the broader question of yield is an impediment to Bitcoin in the same way that higher yielding markets have been an impediment to gold for decades, right? It increases the hurdle rate, increases the cost of holding it. To the extent we're seeing, issues in Japan, I think that can contribute in the short term. Long term, I think I think the fundamentals win out. But I certainly think those are reasonable to look at as a short-term in. For instance, worth noting that Bitcoin's downtick more or less correlated with the moment when our own Fed became more hawkish on the outlook for interest rates. I think that's going to be a short-term hawkish pivot. So I actually think we're gonna go back to expectations of much lower rates. But you see that correlation for sure if you look at when Bitcoin dipped. It was almost when that hawkish tilt happened on the nose.
Got it. Okay, let's shift over to today's official theme because while we're being distracted by today's momentary pricing, we need to remember this is a long-term technological innovation that is being widely adopted. And it was easy in the beginning because it was only Bitcoin. Um, but then came Ethereum in 2015. And Ethereum was created to solve a problem that Bitcoin had. And Ethereum had a problem, and Solana was created to solve a problem of Ethereum. So walk us through that, Matt, the metamorphosis, because we can't understand Solana staking until we understand Solana, and we got to understand Ethereum and Bitcoin to understand Solana. So give us the quick rundown of how did we get here, and what is it? Why does it matter?
Yeah, it's such a good question. So, Bitcoin created the first blockchain, and it was a scientific breakthrough, a computer science breakthrough for the ages, right? The first time ever we could have a scarce digital good. That's kind of why we call it digital gold. It's the first ever scarce digital good. And that's being a killer use case, right? We've seen Bitcoin go from $0 to $2 trillion, one of the most successful startups of all time. But creating a scarce digital good is not the only thing you can do with a blockchain. Ethereum looked at Bitcoin and was like, it's cool that you created digital money. What if you could program it to act like a bank? What if you could program it to act like the New York Stock Exchange? What if it could be a global network for moving digital dollars around the world? What if we could move stocks around the world on blockchains 24/7 at very low costs instead of using the traditional system? So it used blockchain technology in a different way than Bitcoin. Bitcoin's technology actually can't do these things. It's designed to be maximally simple, maximally secure. It's fantastic at being digital gold, but it can't be the New York Stock Exchange. So Ethereum said, let's make this money programmable. Okay, an amazing use case. And we've seen the real world applications on Ethereum start to gain enormous traction, right? Stable coins are primarily issued on Ethereum, and you can move money around the world in a second for a fee of less of a penny. Tokenization primarily happening on Ethereum. Incredible. You can trade stocks 24/7 with instantaneous settlement anywhere around the world. Unbelievable advance. But Ethereum has an issue, which is it can only process so many transactions at once, right? Its throughput is only so big. Ethereum has tried to solve this issue by creating what are called layer twos. The way I think of layer twos is if Ethereum is a highway and it's get clogged, you have these parallel access roads that can move traffic instead. That's one way to solve the problem of throughput. But throughput is a technical problem. Solana looked at it and said, I can solve this in a different way. Instead of having a highway and then a million parallel access roads, I'm just going to build a really big highway. So Solana can
Duh.
process, yeah, giant 10,000 plus transactions a second. The fees are reliably a penny, whereas on Ethereum, they used to spike into the tens of dollars for a single transaction. This is an incredible use case. It's easier to use. Now, it has some trade-offs. Solana is more centralized. It's a little bit more fragile. Ethereum is more robust. It's more decentralized. But these are technological solutions that just offer a different way of doing things, right? And what the market is trying to decide is which one is more attractive. Right now, Ethereum has the largest share. It's 5 times bigger than Solana. There's more stable coins on Ethereum. There's more tokenization on Ethereum. But many people think Solana is catching up, right? And so, like any technology or any new era, you're going to get multiple competitors. And Solana is maybe the most interesting competitor to Ethereum. And that's why there's been so much interest in BSOL, our new ETF covering Solana.
And although Ethereum is 5 times bigger than Solana, let's remember that Ethereum is now 10 years old. Solana has been around a fraction of the time, and the fact that it has gained as much as it has in its brief history is a clear evidence of the level of attractiveness it has among not only investors, but commerce using it as a platform for business.
That's absolutely right. Yeah. And it's starting to catch up on these more institutional use cases. One way I think of it is like Ethereum had this giant lead. And for a while, it was the only blockchain that had the SEC's blessing. It was the only thing besides Bitcoin that was clearly not a security. So if you were a large institution like BlackRock and you were looking at these programmable blockchains, of course you were going to choose Ethereum. No one got fired for choosing Ethereum. The reason we're starting to see Solana win more mandates is now it's been running for 5 years. Now it has a track record. Now it is moving up the regulatory stack. Now there is an ETF. And so increasingly, you don't get fired for building on Solana either. And what you're seeing is it's sort of ratcheting up this institutional scale. One more point on that, Rick. The initial applications of Solana were mostly crypto native retail applications. It was the home for meme coins. It was the home for many NFTs. But what you're seeing now is that it's winning these institutional mandates, right? It's winning mandates for international money transfer. It's winning mandates for stock IPOs. You have Kraken and others building on Solana. So it's become a really viable competitor. And I think when you invest in Solana, you get to make these two different bets. One, you're betting that this stablecoin tokenization programmable blockchain space is going to grow. If it grows and Solana keeps its current market share, you should do well. And then you're betting that Solana will eat into the other's market share, that it will steal from Tron, that it will steal from Ethereum and have a bigger space. And when you stack those two viewpoints on top of one another, you can start to imagine very high returns. I think that's why people are excited by the asset.
And just to give folks an idea of the increased market share you're referring to, people are surprised at these two numbers I'm about to share with you. You know them very well, Matt, that already stablecoins hold 10% of all US currency in circulation. 10%. That's astonishing. And the Treasury Department says over the next 2 years, it's going to grow to 80%. So we're talking about astonishing levels of growth of stablecoins, and they're predominantly trading on Ethereum, as you said. So how can you have an 8x increase in stablecoins without a significant increase in the price of Ethereum?
That's exactly right, and that's true for each of these assets. This is a massive growth industry. It's a secular growth. Like it doesn't matter if there's an AI bubble. Stablecoins are still ascendant. You see them adding on more use cases. We just got the Genius Act, which brought these into the regulatory fold. It's actually not even in place yet legally. We just know where it's going. So we haven't even felt the afterburners of that. And so it's very easy to be excited about stablecoins. And then you have to decide, well, which platform am I going to bet on, or am I going to bet on all of them? And see, whoever wins, I'll get exposure to that.
All right, so now what I want to do is talk about Solana ETFs, and I want to break this into two parts. First, the fact that we had Bitcoin ETFs first, as you noted, in January of 24, nearly 2 years ago. That was followed several months later by the Ethereum ETFs. And now Bitwise has just launched a Solana ETF. So I want you to talk about why and the evolution of that. And after we do that, I want to ask you about staking, because this is a fundamental distinction between the Bitcoin and Ethereum ETFs. So first, talk about BSOL, the Bitwise Solana ETF. Why did you launch that as a single asset ETF? Why was that so high on your priority list? And talk about how it differs from the Bitcoin and Ethereum ETFs.
Yeah. I think about sort of the Mount Rushmore of crypto, Rick. So these are the assets that are leading the industry and without which an investor doesn't really have full exposure to crypto. Obviously, Bitcoin is up on the Mount Rushmore. It's the OG, it's the most important asset, the largest share. Ethereum is definitely on the Mount Rushmore of crypto because it created this category of programmable blockchains, the largest platform for stablecoins and tokenization. But there's room for a few other names up there. I think Solana is the next obvious candidate. So at Bitwise, we help professional investors gain exposure to the most exciting opportunities in crypto. Solana is one of those opportunities, right? I think anyone you talk to that looks across all the crypto assets and had to name the 4 or 5 most interesting, they would choose Bitcoin, they would choose Ethereum, and they would choose Solana. It's just, it has enormous momentum in the market, enormous developer activity, a great ship first culture, and it's winning share of these growing markets. So that's why when we looked around at what comes next after Bitcoin and Ethereum, to us it was clear that it should be Solana, and that's why we pushed BSOL over the line.
So now we need to again go a little bit backward, a little bit of crypto 101, and explain staking, how that fundamentally differs from the way Bitcoin operates on its blockchain. Uh, Explain what is staking, how does it work, how does that translate into investor return, and the role of staking in the Bitwise Solana ETF.
All right, I'm going to start at 101, just in case there's anyone on the webinar that needs this, but I'll move fast to 301. So the place to start is with Bitcoin and with proof of work, right? If you think about what a bank does, it processes transaction and secures the network, and for that you pay it a fee. What Bitcoin does is it processes transaction and secures the network, but there's no bank, so you're not paying a fee to a centralized entity. The people who process those transactions and secure the network, in Bitcoin we call them miners. And the way they do this is they buy high-end computer chips and plug them in to consume a lot of electricity, and then they compete to process those transactions. Why does the network force them to buy these computer chips and use all this energy? The reason is they have to make it costly to propose a block of transactions. If all these miners could propose a block without any cost, they would constantly be trying to spam the network. They would try to send all the Bitcoin to Rick or send all the Bitcoin to Matt. There would be all these illicit transactions, and the network would waste a lot of energy catching them and punishing them. It's much easier to make it costly. If you make it costly, they're only going to propose true transactions because the cost of trying to get something illicit through, they won't let it through, and then you'll have wasted all this money and energy and chips. So the reason miners use these chips is to raise the cost of proposing transactions to keep everyone honest. But there's a downside to it. There's a lot of electricity consumed, there's carbon, it's high cost, high touch. You have these expensive machines. Proof of stake was proposed as an alternative, and it sort of flips that on its head. The way proof of stake networks work is that instead of burning computer chips and energy, you put up a bond. You say, here is X dollars in Ethereum, or here's X dollars in Solana. I'm only going to propose honest transactions to be settled. And if you catch me proposing one that is fake, that is fraudulent, you can take the Ethereum or the Solana that I've posted as my stake. So it's another way of having a cost to being dishonest. And it's worked phenomenally well. Solana, in this case, uses a proof of stake ecosystem. And so when you have Solana, you can stake it on the network. And if you run the validators, you get rewarded in two ways. One, just like with Bitcoin's proof of work, every time you settle a block of transactions, you receive a grant from the network of new Solana in this case. The second is that because you're processing these transactions, you can take sort of extra credit for how those are ordered and get a little bit extra yield. When you add them together, the opportunity is significant. The total sort of staking rewards available in Solana are something like 7% a year. So this is a really important part of the total return. The beauty of something like BSOL is we hold Solana in institutional custody in 100% cold storage, and we stake it and stake 100% of the assets to capture that 7%-ish target range of yield. And it's a really powerful combination. It supports the network and enhances investor returns.
So contrast that 7% yield from staking to the yield that is offered by Bitcoin and Ethereum.
Well, Bitcoin is easy, it's zero. So that's what you get because there isn't this staking element. And Ethereum is very relatively small. It's a couple percent. So it does have staking, but it's much less important than Solana in terms of your total return yield. I don't think you want exposure to Solana while missing out on 7% a year. It's just too big a target to ignore.
And that's a retort to one of the common criticisms of crypto that historically have said there's no yield, there's no income, there's no dividend, there's no interest, which I can get from stocks and from bonds and no rental income from real estate, et cetera. The only reason you buy Bitcoin or anything else is you hope its price goes up. Well, now, thanks to staking, you're not entirely relying on appreciation. You now have an income generator.
That's exactly right. And I'd like to point out just how similar this is to the traditional system. To go back to that banking example, when you buy a bank stock, the dividend you get is the fees that it's accumulating for processing transactions and securing people's wealth, right? They charge fees and they pay them out in dividends. In Solana, the yield that you're getting is the fees that are generated from processing transactions and securing the network. It's actually the same exact idea just packaged in different words, delivered in different ways. But it is important. You are a part of this company, Solana, if you want to use that term. When you stake your assets, you're part of this effort to create this valuable network. You contribute work to it and you receive a reward. That's what we're doing with BSOL, and that's what you get as a BSOL shareholder.
So we know as financial advisors, we are trained in this. We've seen it in our experience that the greater the return, the greater the risk. So we know that in the world of bonds, if there's a bond paying 7% versus a treasury of 3, that 7% bond must be taking greater risks. So talk
Yeah.
about risk in the world of crypto, and is that 7% yield particularly risky?
Oh, that's a great question. It's risky if you execute the stake poorly. This is one of those situations where if you don't when you're staking Solana, you're committing to a certain amount of uptime, you're committing to doing it in an accurate manner, you're making all these commitments to the network. And if you don't succeed in delivering those commitments, if you have a computer that turns off, if you're not processing transactions, if you're not supporting the network, you lose that yield. So it's risky in the sense of you may not get the reward if you're not doing it at extremely high quality. That's why Bitwise partnered with Helios, one of the best known sort of software designers in the crypto space, to do this staking, because we want to do it best in class. Now you don't lose your underlying Solana. You're putting the reward at risk. That's 7% risk. But you do have to do it well, Rick. This is a pay for performance game on the staking side. And so you have to do it exceptionally well.
So there is a feature within ETFs that I think is really worth elaborating on. When an ETF chooses to engage in staking, it has a choice as to the extent of the staking. Will it stake the entire portfolio? Will it stake only a portion of the portfolio? Talk about how Bitwise makes that decision and what its decision was.
Yeah, so this is really important. When you stake an asset, you're tying it up in escrow, right? You can't stake it and immediately pull it back. You're saying, here this is, I'm locking it up for a period of time. In Ethereum, that period of time can be significant. That's why you see many Ethereum ETPs stake less than 100% of their assets because they need to reserve some in liquidity. In Solana, it is typically a day or two, but it can extend during periods of stress to be longer than that. So the question is, how much of your assets do you stake? We're really proud at Bitwise that we've created a mechanism, which you can read through in our prospectus, that allow us to stake 100% of the assets while still being able to fulfill the liquidity requirements that you need to with an ETF that has daily redemptions. The way we do it is that there's a trade facility there that in those unusual 1% edge cases where the unbonding period for staking your Solana extends beyond a day or two, which is the window you have to settle things. We have trade facilities with market makers that allow us to sell staked Solana in exchange for liquid Solana to fulfill those creation or redemption orders, right? So we have a way to transfer staked Solana, which the AP knows will become unstaked in the near future for Solana that's unstaked. There can be a small cost to that. So there can be some slippage, but it's far outweighed by the ability to capture those 7% returns for the 99% of the time, 99 plus, that historically this hasn't been a big deal. So we've chosen to stake 100% of our assets. We think people who want to buy an ETF should have an easy button, which means low cost, qualified custody, institutional liquidity, and 100% staked assets. So those are the characteristics that we designed for with BSOL, and we're really pleased that we're able to do that.
So Michael is asking about that 7% yield. What do you think about its stability? Is that yield going to rise, fall, and what are the drivers that affect it?
Yeah, there are two pieces to that. So there's the inflation aspect where the blockchain issues new Solana. That declines over time. So that part is going down. And then there's the aspect that's related to the amount of activity on Solana. And our expectation is that will go up over time. And the question is, how does this decline of one and upward trajectory of the transaction level revenue cross? We don't have a specific guideline to that. All we can do from an SEC perspective is sort of report on what the available yield in the market is at the current moment and what we've been able to capture historically. But you have to think about those two elements going forward. Because Solana is such a transactional blockchain, because that's its orientation, we think the yield opportunity in the space will continue to be robust for a very long period of time.
James wants you to elaborate on your comment earlier about the risk of staking. If you stake and the validator function fails, you may lose what? Is it the coins you've staked or only the yield you would have otherwise earned?
Yeah, in the case of Solana, it's the yield you would have otherwise earned. There's not the direct sort of slashing that you have in Ethereum, where you can be punished with the existing stake that you've put up, where you can lose a portion of those coins. On Solana, you're talking about the ability to aggregate that yield going forward, and the loss of that revenue opportunity is what keeps people honest.
Got it. Lindsay and others are asking about the tax implications of the fund.
Yeah, that's a really good question. I'm not able to provide tax advice, as you know, Rick. That is typically a no-go. But I encourage people to look at the prospectus and consult their own tax advisor. The yield is poured back into the NAV. So you're not receiving income payments. It's not like you get a 7% cash dividend. What you see is an increasing NAV over time, but please do consult your tax advisor for that guidance.
What we can say clearly is that it's a 1099, not a K1,
That is correct. Yes.
and it's just an ETF, so it's going to be on your ordinary brokerage account statement like any other ETF.
Yep.
And it's interesting that you're dodging the question because you have to, and it's also partly because the IRS, I don't know, has been completely clear yet in what they regard staking revenue to be. Is it a dividend? Is it interest? Is it a capital gain? When do you is it unrealized or realized? I mean, there are a lot of open questions, aren't there?
Yeah, there are indeed, and there is a lack of clarity, a little bit of a lack of clarity. The situation is evolving and getting better, but there is, to be sure, some lack of clarity at the IRS on exactly how to treat these things.
So I'll say this, Matt, you can either choose to say nothing or you can agree. Notice I'm not letting you disagree. Um, that the worst case scenario is that the staking would be considered ordinary income at the time it's provided, meaning the way bond interest would be or a bank CD interest would be. That's as bad as it gets, meaning you're going to pay the top tax rate now. That's about as bad as it can get. It can only get better if they make different decisions, like it's a capital gain and you only pay when you sell kind of thing. Would you agree that with that scenario?
I'm gonna let my tax advisor comment stand. So this is
Okay.
you're better positioned to provide this advice or these thoughts, not even advice, than I am.
Yeah, so I would just say, treat it like the worst case scenario. It can only get better. And that way you're safe. Uh, Something else we got to do. You and I have been guilty of this, me more than you, because I don't care about the regulators the way you do. Um, the difference between an ETP and an
Mm.
ETF. You use the phrase ETP because that's technically more accurate. I refer to them as ETFs because we're all more familiar with that phrase. But James is asking, what's the difference between an ETF and an ETP?
This alphabet soup stabs me in the eye, of course, Rick, because I was part of ETF.com, and I remember with Jim Wyan acquiring that URL. So we are, I firmly, from a heritage position, consider all of these ETFs. The difference that the regulators insist on is that the F in ETF refers to fund, and funds technically are governed by the 1940 Act. That's like an S&P 500 fund or a bond fund. Crypto, single asset ETPs, are governed under the 1933 Act, which is not the 1940 Act, and therefore they are not funds. The P stands for product, which is a more inclusive category than F for fund. Under the previous SEC and indeed under FINRA guidance, we were requested to refer to these as ETPs and not ETFs. So that is the conclusion. Um, from my own personal perspective, I of course think most people think of these as ETFs, but they're not technically funds under the 40 Act. They're under the 33 Act.
I would argue that, so many of you agree or disagree, that all dogs are animals, not all animals are dogs.
I
So
think that
all ETFs are ETPs, not all TPs are ETFs.
it's hard to disagree with that. That is precisely right. Yes. So it's a catch-all category. And
And the difference is in the certain regulatory safeguards or regulatory methods, procedures, disclosures under those different sets of rules, and nobody cares except lawyers. You
It's
don't want to
wonderful to
comment on
be in
that.
your seat and to be able to say things directly, Rick.
Yeah. So I'm going to keep calling them ETFs, even though I know I'm technically inaccurate. Um, some more questions about the nature of staking. These are really good questions. People are being really thoughtful about this. How often does the staking revenue get paid?
Yeah, so it accrues to BSOL on a daily basis. So you see it in the NAV on a daily basis. This is crypto is a 24/7, 365 market. And things drip. They don't do periodic payments. So daily basis it is.
William's being very clever here. If I hold BSOL in an IRA, I don't have to worry about the tax question,
That
right?
is definitely true, I believe. So that's a smart comment.
Yeah. So yeah, that's the way you get around all of this. Um, Eric's asking a fundamental question. Why use BSOL, the Bitwise Solana ETF, instead of just buying Solana at, Coinbase or somewhere?
Yeah, this is a great question. It's the same reason why I use BITB to access Bitcoin and ETHW to access ETH. When you buy an ETF, you get certain advantages. You're assured that it's always institutional custody, at least with Bitwise, with a qualified custodian. In the case of these assets, we use Coinbase Custody, which is a separate legal entity from Coinbase, the app. So it's a bankruptcy remote. If Coinbase, the app, runs into issues, there's no issues with the custody. Those institutional custodies have insurance in place against certain losses. You're accessing institutional trading, and you're getting institutional fees. So you as an individual will pay higher fees to gain access to Solana, Bitcoin, or Ethereum than I do managing $15 billion of crypto. I can negotiate lower fees, and those show up in the low expense ratios of 20 basis points. So it's more secure. It's easier to use. It fits into your traditional financial planning. You can do estate planning around it, and it's the easy button. One thing I love to say to people to point out how true this is that if you look abroad, the Abu Dhabi Sovereign Wealth Fund uses an ETF to gain exposure to Bitcoin. Harvard, to go back to your example,
Right.
chose an ETF to gain exposure to Bitcoin. If the Harvard Management Company wants BlackRock or Vanguard to fly out and play pickleball and talk about the best way to access an asset, they'll be on the plane the next day. It's the largest, and for them, the cheapest, most secure way is to buy an ETF. The beauty of the ETF structure is you can buy the same ETF as the Harvard Endowment. It's absolutely incredible. So the answer is it's cheaper, it's probably safer, and it's the easy button that fits into your financial planning. It's somewhat of a no-brainer, I think.
You don't have to worry about the opening a wallet and dealing with all that crypto jargon kind of stuff. It raises the question, since you hinted at it, I'm going to make you say it point blank. Talk about the fee.
Talk about the fee. I mean, the fee is very low, right? The fee is very low. So Bitwise wants to make it easy to gain access to this. So 20 basis points all in. That's to my view an incredible deal. It's the same as Bitcoin, same as Ethereum. We want to help financial advisors gain exposure to the opportunities in crypto. To say something that maybe is not obvious, a lot of people wonder, why does Bitwise think it can make money on such a low fee? The answer to that is I think these will be very large funds. People ask the same question when we launched a Bitcoin ETF. Today we have $5 billion. At $5 billion, that's significant revenue. So it's not a charity case. It's just the best deal any investor can get. So I'm optimistic about Solana. I'm optimistic about the growth of BSOL. And so we priced it at this extraordinary low level, half the fee of the largest gold ETF. I think it's a great deal.
And just to put that in context, if you go to some of these crypto exchanges, you can often be charged 1.5 or 2% each way of the trade when you buy and when you sell. So you're talking 3 or 4% compared to 20 bips a year. So I think that the cost advantage for the ETFs is pretty clear. Scott wants to make this very simple and easy for clarification purposes. I love Scott's question because he's taking complexity, making it simple. If the price of Solana stays consistent, would BSOL show a price increase of around 7%?
Yes, if we're successful in recognizing that yield, yes, great question, and yes is the answer.
And that relates to another question that somebody sent in when they registered. How do you explain all this to clients? I think what you just said, what Scott just asked, is a great way to make it simplistic. But elaborate on that, Matt. How do you explain? And look how long it took you to go from the history of Bitcoin to Ethereum to Solana and then staking. How does an advisor succinctly, easily explain all this to a client?
Well, I think on the Bitcoin, on the Ethereum versus Solana, I always like to use analogies. Like go back to the early days of any technology. Did you want VCR or Betamax? Did you want Google or Yahoo or Ask Jeeves? Did you want Netflix or Hulu? Did you know for certain which of these would win in the long term? The answer for most people is no. The reason Solana is interesting is it's the leading challenger asset in a very high growth area of stablecoins and tokenization. So do you want some Ethereum? Probably yes. Do you want to bet everything on Ethereum and not have Solana? I think probably no. And if you're looking for risk, you might want to bet on this challenger asset. Maybe this is Facebook coming after MySpace, right? And you want that exposure early in its journey. That's what you're getting with Solana. So I like those sorts of analogies. My family had a Betamax. That turned out to be wrong. And so I like thinking about it that way. On the staking side, I don't know that you need to explain it most. You can just say that this asset is able to generate a 7% yield by staking its exposure. And if they ask what that means, is it contributes to processing transactions on the network and it gets a reward for doing that.
I
And I
liked
think
your
that's
earlier analogy about banks collecting fee revenue and distributing it back out.
it's the same thing. Yeah, I think that's a good analogy. I mean, that's what banks do, and that's what Solana does. It's the same thing. Crypto likes to make things feel different and look different and use different terms, but it's actually the same mechanism.
Somebody wants to know, in fact, before I get to that, let me go to another question that somebody asked in advance, and that is the role of BSOL in a diversified portfolio. You just kind of hinted you wouldn't want to own this all by itself. Talk about the crypto allocation generally. What percentage of the portfolio ought to be a crypto allocation? And then within that, how much in SOL?
Yeah, well, I like your answer better than mine. I think you told people up to 40% of their portfolio. I'll say what we're seeing is we're seeing a lot of advisors allocate between 2.5 and 10% of their assets to crypto. That's up. If you had asked me this a few years ago, I would have said 1 to 5%. Now we're seeing 2.5 to 10. The reason for that is the volatility of crypto has come way down. And so you can allocate more to it. What do you do with that, let's call it 2.5 to 10% of your portfolio? Well, the right way for many investors is start with a market cap weighted exposure, right? Which would mean a lot of Bitcoin, some Ethereum, and a little bit of Solana. That's your base case portfolio. You can look up the market caps, right? 2 trillion, about half a trillion, and about $100 billion. That's the relative size. But some investors may want to, just like they do in the equity part of their market, take that base exposure and overweight assets they have extra confidence in. So we see a lot of investors have that base exposure and then overweight Solana because they're really excited about its competitive position versus ETH.
Yeah, I like that answer a lot. And let me going back to that 7% yield question. Somebody anonymously just asked this: what's the realistic expectation for a default rate or error rate on on that yield generation on the staking. In other words, 7% if you're up 100% of the time all year long. Is there a reasonable expectation that you won't be up 100% of the time and therefore you don't get 7? If you're down 10%, you'll get 6.3?
Yeah, I mean, there's no guarantee. We can't guarantee anything. As disclosed in the prospectus, there's risks to doing this right, but we think we have the best possible technical setup with the smartest and best respected people in the Solana ecosystem. So we're optimistic that we can generate that kind of return, but you'll have to look at how it pans out over time. You should start seeing that reporting, in a month or two. We launched this fund on October 28th, so we'll have our first month done at the end of November. Let's see how we did when that reporting comes out.
And so we have two factors. One is the degree to which you're not capturing the full stake, and the second is the fluctuation in the stake yield itself. So if you were to, I want to ask for a bet, give me a range. What would you expect over the course of a year that the yield may in fact be as little as X or as big as Z?
Yeah, we've seen it historically be relatively stable at these sorts of levels. So, again, we can't forecast necessarily going forward, but I think if you're thinking in the 5 to 7 or 8% range, you're talking about the right type of range for an asset like this. And we're committed to staking 100% of the assets, and we think we have the technological solution to do it quite well. So we're very optimistic about our ability to harvest that yield in the early days of an ETF, because you can have significant inflows, that can cause the amount of yield to fluctuate as well a little bit. So there's some of these details that can make the first few weeks a little bit different from the long run. But look, we're committed to doing 100%. If you look historically, this kind of yield has been sticky across the Solana ecosystem. And so we're going to try to deliver that on behalf of investors.
So if I were an advisor talking to a client, I would promise little, deliver a lot. I would emphasize, I hope we're going to get 5% or more out of this. You deliver 7, you'll be a hero. If you tell them 7 and they get 6.5, you're toast. So
Totally
be
agree.
careful, be careful what you're saying to clients. Here's another great question from somebody anonymous. It was easy back in the day, Matt, when all there was Bitcoin, to say when you allocate part of the portfolio to Bitcoin, pull it out of the equities. In other words, if you had a 60-40 portfolio, you would now have 58-40 and 2, right? Because Bitcoin is an ownership asset, you're buying it for appreciation, sounds like a growth stock. So treat Bitcoin like an equity because there's no yield. But now you've got a 7% yield on Ethereum, on Solana. So do you still take it out of the equity part of the house, or do you treat it from the bond side of the portfolio?
I think it's a really interesting question. What we see advisors do is taking it out the equity side of the house. I think for the reasons that you explained, Rick, which is that it has high appreciation, it has a reasonable degree of risk. Those are characteristics that we traditionally assign to equities, and people therefore are assigning them to crypto. But when you start to introduce a bond-like exposure, or a bond-like yield, when you start to introduce a non-correlated asset, you can think about maybe you should pull them proportionally from the two sides. I will say statistically, if you go back and do portfolio modeling, you get fantastic returns if you're actually pulling out of the bond side of your portfolio and maybe de-risking the bond side of your portfolio to make space for some of this crypto exposure, particularly with yield. Maybe you don't need to extend as far out on the credit spectrum. Maybe you don't need to extend as far out on the duration spectrum. I think there is a case to be made for pulling some out of one and some out of the other, maybe a market cap weighted across the board takedown to make space for this new emerging asset class.
Makes a lot of sense. William's asking a really good question. It has nothing to do with BSOL, but BITW.
Yeah.
Solana is in the Bitwise 10 crypto index fund. Is Bitwise staking the Solana in BITW?
Yeah, so currently, I mean, it's important to know BITW is not yet an ETF. We've applied to uplist it with the SEC. Now that the government is open, we're very excited to hopefully engage with them on moving that process forward. Currently, there is no staking in the Bitwise 10, and there are some complications that come with managing a diverse array of assets, but it's something we're engaged with and looking at. So right now, the answer is there's no staking in the Bitwise 10. In the future, the answer is we are looking at it and we'll try to make the best choice for investors, but I can't provide guidance on which way that will be.
But considering that Solana plays a relatively small piece of that fund, the staking will be a relatively small amount of pure dollars.
That's exactly right. Right now, Solana is 2.9% of that fund. So even if you were capturing this 7% yield, that's 7% on 2.9%. That is a rounding error on the fund structure. So we'll only do it if it makes sense from a tax and complication perspective. If that's the case, we do have this expertise. We've proven it out with BSOL. We've proven it out with our own staking division, which stakes billions of dollars of assets on behalf of large crypto investors. And so we will be on top of considering it, but you're right to point out it's a small part of the portfolio today.
Avtar wants clarification. Since we mentioned that you can own BSOL in an IRA, Avtar wants to know if you can also hold it in a Roth IRA.
Well, that's a good question. I believe the answer is yes on the IRA side.
Mm-hmm.
The only space in the retirement space where there's still not full clarity on crypto is in the 401k side, but that's a separate side of the house. On the IRA side, check with your tax advisor, but from my understanding, crypto can be held in multiple types of accounts.
Regarding the performance of BSOL to date, Bitwise, I don't know if this will be in the future argued as good fortune or bad fortune. I think it'll prove to be good. That you opened 3 weeks ago when Solana was much higher in price than it is today. So when you look at the current performance of Solana, which is down along with all the other crypto assets, it would have been down even more had it not been for the staking. Is that correct?
Yeah, I think that is right. Of course, the small amount of staking revenue that you can gain doesn't offset the broad market move. We've seen Solana retrace from north of $200 substantially downwards, right? So I do think these are attractive entry points for investors. I'm actually excited to have our ETF in the market today with Solana priced where it is. The staking yield helps cushion that downside, but if the market retraces 20 or 30% in a month and you're getting 1 month's worth of a 7% annualized return, that's less than a percentage point of cushion. So make no mistake, the big driver of return of BSOL is the return of Solana itself. The staking element is like the cherry on top, designed to maximize the return that's available to you, but it is not the dominant driver of returns. It is that market return that will be the big driver of returns for Solana and for BSOL.
And let's keep in mind that that 7% yield is an annual return, not, this fund's been around for 3 weeks, so you wouldn't have earned 7% in the past 3 weeks.
That's what I mean. Yeah, divide that by 12 and maybe more because it's only been less than a month and you're at like half a percentage point, right? It's not a huge number.
Right. Somebody meaning anonymous, wants you to comment on the competition. Are there other Solana ETFs out there, and how does Bitwise's ETF compare?
Yeah, for sure. There are more Solana ETFs launching from other providers. We welcome that onto the scene. We are, as far as I know, the lowest cost and the only one that's taking 100% of its revenue from its ongoing expense ratio fee perspective. So I think the largest, most liquid, 20 basis points and 100% staked from a crypto specialist with 8 years experience is a compelling set of characteristics. I think that's why it's the dominant ETF in this space. But there are, of course, more competitors here, as there are many competitors in the Ethereum ETF market and the Bitcoin ETF market. And we welcome those competitors on the scene.
I would agree, because the more competitors out there creates more legitimization, if that's a word, of the asset class. I'm always skeptical when somebody comes up with something, they're the only one who did it. If it was such a great idea, you'd be hearing about this pretty much everywhere.
I think that's right.
Um, Somebody has a thesis. Michael's got an interesting thesis. Tell me if you support this, Matt. The benefit of the price of Solana being down is that you're essentially dollar cost averaging with the staking rewards, and that creates an opportunity.
Oh, that's an interesting viewpoint. I hadn't, to be honest, thought of that, but that is mechanically true when the market is retracing, that you are almost doing the equivalent of adding some additional Solana at each stage. And therefore, you're DCAing over time at a tune of 7% of your initial investment. I like that theory.
Yeah, I agree. It does. I think that does have legs. There is a ton more to understand in the chat. Michelle has posted the link to the Bitwise, first their website generally, Bitwise Investments, but specifically the BSOL ETF that's available to you in your link. Matt, we've got just a couple of minutes left. Give us your closing thoughts. What takeaway message do you want everybody to walk away with?
Yeah, I would just say that I think Solana is one of the most interesting assets in the crypto ecosystem. It's a lot smaller than Ethereum, but it's an interesting challenger to Ethereum from a technical perspective. It's got high throughput, extremely low cost, extremely easy to use. And as a result, you're seeing it win more and more of the stablecoin and tokenization space. That makes owning Solana interesting. And I think the interesting thing about BSOL is we tried to design really the platonic ideal for gaining exposure: low fees, liquid, substantial in size, 100% staked, trying to capture that full 7% yield from a trusted crypto provider. When you put those two together, I think that explains why we've seen so much exposure. And I would just add, I think this stablecoin and tokenization theme is here to stay. I think it's going to be bigger in 2026 than it is in 2025. And I still think the opportunity to get in these prices is pretty intriguing for the right type of investor. Not for everyone, but for the right type of investor.
I couldn't agree more. And I think the fact that Bitwise has been such a leader in not only the development of BSOL, but in the 100% staking, which makes it, I think, unique in the marketplace, with something that's offering a 7% yield these days, is pretty compelling and demonstrates that the universe of crypto is growing at an exponential rate. It's no longer your father's Oldsmobile. It's not just Bitcoin, but we have some really innovative, clever ways to improve your client's diversification, improve the risk-return ratio, generating income from resources you never thought available. Wonderful ways for you to show value add to your client. So I'm really impressed with this product and encourage you to learn more about it. Matt, you elaborate on this. You've got a wholesaling team, a network of folks who run around the country ready to come to any advisor's local office.
That's exactly right. So reach out to us, sales@bitwiseinvestments.com. We'd love to come and do a teach-in with you or your clients or answer any of your questions. I'd also throw out a really interesting offering we have. One of the things we just do every day. If you ask a question about crypto, say you have a follow-up question on this webinar, and you ask your local wholesaler, they'll give it to our research team of crypto experts, and we'll come back to you with an answer within 24 hours. So when your clients ask you a detailed question about crypto that you don't know the answer to, just turn to Bitwise. That's why we exist. We're there to help you succeed as an advisor in the crypto space. And so that is always available every day. Just talk to your local wholesaler.
That's Matt Hougan, the CIO of Bitwise Asset Management. Always a pleasure, Matt, to have you with us. I want to let you know we have a couple of other webinars coming up on next Wednesday, or in a couple of Wednesdays from now after Thanksgiving. Crypto Exposure Simplified, index-based ETFs, and why they're becoming of interest. Then we have the Year in Crypto in December, the 2025 highlights, and what to look for 2026. And we mentioned earlier my white paper that Matt loves because I encourage folks to have an allocation, a minimum of 10% for conservative clients, up to 40% for aggressive clients. If you haven't read my white paper, it's available for you for free. Just click that link or go to the QR code or visit us at DACFP.com. And my other white paper, the 6 mistaken beliefs that are keeping you from buying and recommending Bitcoin. This will dispel the reasons that a lot of your clients are hesitant to engage in this. And if you really want to become proficient, as everybody on Matt's external teams have done, they all hold their CBDA designation, and you can too. Become certified in blockchain and digital assets. An online self-study course, world-class faculty. You get up to 18 CE credits. You'll not only learn all about the tech, what is it, how does it work, but you'll learn how to integrate all this into your practice management. And I strongly encourage you to obtain this so that you can demonstrate to your clients that you know what you're talking about. And if you really want to have a lot of fun, come join us in Dallas, June 8th to 10th. It is the oldest crypto conference exclusively for advisors. It's a one-track program. You can really get the latest and greatest on what's happening in crypto, and we're really excited about this course. 2.5 days in Dallas, you'll really have a great time. And if you haven't read my #1 Amazon bestseller, The Truth About Crypto, I encourage you to do. Publishers Weekly called it a great resource. And we have a monthly e-newsletter that you can subscribe to for free, where we'll give you the latest insights. Matt often contributes to this for us, so I encourage you to get that newsletter for free. And let me change subjects totally and completely in our final minute. My brand new book on college is coming out in December, The Truth About College. College is an absolutely great path. Most families that are earning over $200,000 a year have a college grad heading that household. But the flip side is that 24% of college freshmen drop out and only 62% graduate after 6 years. You need to make sure your clients' children are going through the college decision-making path correctly so that college is a successful outcome and doesn't ruin the teenager's life. And that's what The Truth About College will provide for you, to help you provide a greater value add to your clients as they're dealing with one of the biggest worries that all parents have. The Truth About College at your favorite bookstore. And if you live on the East Coast or are traveling the New York, the DC corridor, take a quick detour off of I-95, the New Jersey Turnpike, and visit the Edelman Fossil Park, a fascinating facility that we just opened in March, named by the Smithsonian as one of the 5 most anticipated museum openings of the year around the world. It is an absolutely fascinating place, not only incredible exhibits, but when you go dig in the quarry, you actually get to take home whatever fossils you find, and I guarantee you will find fossils. It's an absolutely fascinating place. I encourage you to visit the Edelman Fossil Park, efm.org. Matt Hougan, again, thanks so much for joining us on today's program. It's been a pleasure as always.
Thanks for having me, Rick.
Thanks, everybody. We'll see you next time.